Imagine opening your phone one morning and seeing the same imported smartphone, the same holiday ticket, the same laptop, the same packet of medicine, all quietly becoming more expensive again. Not because you suddenly earned less, not because the product changed, but because the money in your pocket lost a little more of its strength while you were asleep. This is how currency pain works. It does not enter with sirens, it enters through your grocery bills. It enters through your fuel bills, your EMIs, and the final price of almost everything that depends on the outside world. The rupee is falling, and this time it has crossed a number that economists are paying very close attention to.
The dollar to weaken by about 4-5%, and so that's kind of I think the bigger focus that is going to emerge when you get into 2026.
And this is a very serious, alarming issue which needs to be addressed today. As of the first week of May 2026, $1 costs you almost around 95 Indian rupees. Just pause on that. 10 years ago, you needed around 67 rupees for a dollar. 5 years ago, you needed 75 rupees for a dollar. And last year, it crossed 90 for the first time in its history. And now, it's approaching 95. Now, with analysts watching to see where it stops. Now, I know some of you might say, so what? The rupee has always depreciated and it's been happening over decades. So, and you are right? But here's the thing. The speed matters a lot. The reason matters. And the number 95, that number is not just an exchange rate. It's a signal about something much deeper happening inside the economy of India. Now, because the last time a similar combination of currency pressure, capital outflows, and global dollar strength hit India, analysts put a label on us. A label that stuck with India, cost us investors confidence, and actually rattled our economy at its foundations. That label was Fragile 5. And today, the question being asked in the boardrooms, in the RBI corridors, in the global financial institutions is this: is India heading back there or not? To answer the question, you need to understand first of all what the Fragile 5 actually was, and most importantly, why India ended up there the last time. For that, we have to go to the history, and the year is 2013. And the most powerful central bank in the world, US Federal Reserve Chairman Ben Bernanke, has just said something that set off a financial earthquake across the entire developing world. He didn't announce any war, he didn't announce a recession, he simply hinted, just hinted by the way, that the Federal Reserve might start slowing down its program of printing money and pumping it into the global financial system. That program was called quantitative easing, and for years it has been flooding the world with cheap dollars. Those dollars went looking for high returns, and where did they go? It went into emerging economies, emerging markets, into India, into Indonesia, into Brazil, into South Africa, into Turkey. But the moment Federal Reserve Chairman announced and even suggested the tap might be turned off, investors started panicking. They pulled their money out fast and all at once, and this is what became to be called as a taper tantrum of 2013. And India was hit the hardest with this. In just a few months, the Indian rupee collapsed from around 54 rupees per dollar to 68.85 rupees per dollar at an all-time low at that point. And that fall is a fall of more than 20% in under a year. But here's the part that made it so dangerous. India's economic foundations were already shaken. Our current account deficit, which is essentially the gap between what we import and what we export, had reached a staggering 4.8% of the GDP. In plain language, India was spending far more foreign currency than it was actually earning. Our current account deficit was actually wide. So our current account deficit was actually widening. And to fund that gap, we were almost entirely dependent on the same foreign investors who were now running for the exit. Inflation was running at a 12%. Yes, you heard it right, 12%. Prices were rising so fast that ordinary families were feeling it every time they went to the market. And the RBI had almost no room to cut interest rates and stimulate the economy, because cutting rate would only weaken the rupee further, which would make imports even more expensive, which would make inflation even worse in the country. And in all the situation, India was honestly trapped. Every policy lever, it looked like a dead end. And it was in this context, in August 2013, that an analyst at Morgan Stanley coined a term that India didn't want to hear. They grouped countries like Brazil, India, Indonesia, South Africa, and Turkey into one single basket. And they said all 5 countries were dangerously dependent on volatile foreign investments to fund their growth, and if that investment left, these economies would actually crack. And they called them the Fragile 5. For India, a country that had spent decades building credibility as a rising power, a billion-dollar growth story being lumped in with economies in crisis was a moment of genuine alarm for us. And it actually rattled the government. It rattled the RBI, and it shook investors' confidence at exactly the wrong time. So you see, it created a very vicious circle. That investors' confidence was down, we became Fragile 5, investors' confidence went further down. See, now fast forward to 2025-2026. The rupee has been quietly continuously sliding for over a year. It crossed 85 rupees per dollar, then 88. Then in December of 2025, for the first time in India's history, it crossed 90 rupees. And as of the first week of May 2026, it is sitting close to 95 rupees per dollar. And that is a fall of nearly 12% in just 12 months. The worst performance of rupee in over a decade. Headlines again have returned and comparisons to 2013 are being drawn. And everyone is asking this question, are we fragile 5 again? Let's look at the 3 forces that are driving this particular fall first, because understanding each one is very, very important. The first is the US dollar. The US dollar is very strong, very, very strong. And in the global financial system, the dollar is the default safe haven for all of them. Whenever there is a global uncertainty, whenever there is a trade war, global conflict, geopolitical conflict, recession fears, investors pull money out of emerging markets and park it in the US dollar. This is not specific to India. Every emerging market currency, from the Indonesian rupiah to the South African currency, has weakened against the dollar in this particular cycle. But India has felt it particularly sharply. That is the first reason. Second is foreign portfolio investors. They are leaving Indian markets. And this is the part that matters the most. These are the large global funds, American, European, Japanese, that buy Indian stocks and bonds. They are leaving India. They are exiting India. When they sell and they take their dollars home, there is a sudden sharp demand for foreign currency and a sudden oversupply of rupees. And that is what depreciates a currency fastest. And here's the data that should make you set up. In just the month of March 2026 alone, foreign portfolio investors pulled out the equivalent of roughly $11 billion from Indian market. Yes, the number is right, $11 billion. And this is not a small number. This is actually a stampede. That's the second reason. Third, and the one which is very specific to 2026, the US tariff shock. See, in August of 2025, the US announced a 50% tariff on Indian goods, the highest it imposed on any major Asian economy. A 50% tariff, that means every Indian product entering the US market, whether it be textiles, pharmaceuticals, jewelry, electronics, suddenly became 50% more expensive for American buyers now. Sectors like gems and jewelries and textiles, they saw export volumes fall by 34% year on year. And when exports fall, we all know we earn fewer dollars. When we earn fewer dollars, the rupee weakens further. Now here is where the story gets genuinely interesting, because everything I just described right now, it sounds alarming and it is very, very serious. But when you place these numbers next to what India looked like in 2013, a completely different picture emerges. I'll tell you how. See, in year 2013, our current account deficit was 4.8% of the GDP. Today, it is 1% of the GDP. So it is a bit controlled. That is one of the most dramatic improvements any major economy's external sector in the recent decades. We fixed the fundamental crack in the foundation. In 2013, India's inflation was 12%. Today, India's consumer price inflation is around 1.7 to 2%. The lowest recorded under the current measurement system since 2014. When inflation is this low, the RBI has room to maneuver. It can cut interest rates further. It can stimulate growth. It is not trapped the way it was in 2013. And then there is the number that perhaps matter the most of all, India's foreign exchange reserves. In 2013, when the crisis hit, India's reserves were being rapidly depleted and the country could barely cover 6 months of imports. But as of March 2026, India's foreign exchange reserves stood at $709 billion. $709 billion. That is over 12 months of import cover. This is what you call as import cover. And it is the 4th largest reserve war chest in the entire world. That buffer is what stands between currency volatility and genuine currency crisis. There's a very big difference between the two. So let's be very, very precise about where India stands today. See, the RBI is not asleep. It is intervening, of course. It is intervening very carefully, very deliberately. In the foreign exchange market, it is selling dollars to slow the rupee's fall without trying to stop it entirely. The RBI governor has also stated publicly that RBI does not target any specific exchange rate level. They are allowing the market to find its own level, which is why it's a flexible exchange rate, right? With managed floating, of course. But acting to prevent panic and volatility is what RBI does. And there is a reason for this deliberate approach. A weaker rupee is not only bad news, but Indian exports like IT services, pharmaceuticals, softwares, professional services all become more competitive globally when the rupee is weaker. India's services export have been growing at 14% per year. And that cushion is actually real. But India cannot ignore what is happening. Foreign portfolio investors outflows. At this scale, it means less capital inflow. Less capital inflow means fewer dollars. And less dollars means more pressure on the rupee. And more pressure on the rupee means more imported inflation. So imported inflation, it starts rising again, particularly for the crude oil, electronics, which India imports in massive quantities, by the way. See, the crucial watch points for the months ahead are these. First, the India-US trade deal. If India and US can agree to a trade framework that reduces or eliminates the 50% tariff burden, that alone would restore export confidence and reverse some of the FPI outflows. That is one thing in future. Second is the crude oil prices. If oil stays elevated or rises further, every import bill goes up. Trade deficit widens and the rupee faces fresh pressure. So that is the second thing which needs to be looked forward. Third, whether the RBI cuts interest rates aggressively or not. Rate cuts are good for growth but can weaken the currency, and the RBI is walking a very careful line with this particular part. So these three things are something which needs to be seen. Now here is what I want you to take away from all of this, and I want you to say this the next time someone asks you about this rupee. The fragile 5 label was never really about the exchange rate. It was actually about the underlying structure of an economy. How much it depends on volatile money, volatile foreign money to survive, and how exposed it is when the money leaves or money exits, and how few buffers it has to absorb the shock. By that definition, the definition that actually matters at that point of time, 2013, India today is categorically different from India in 2013. In 2013, when the foreign money left, India had no floor at all. We had a 4.8% current account deficit, I've repeated earlier. We have 12% inflation, again I've repeated earlier. We have thin reserves only for 6 months, and also policy paralysis. The rupee's fall was a symptom of genuinely fragile state, but today the rupee is falling, but the fall is happening against a backdrop of 7.4% GDP growth, 1.7% inflation, $709 billion of reserves, and a current account deficit of just 1% of the GDP. The fundamentals of our country have been rebuilt. The buffers are real. The fall is driven by the global forces, which means a strong dollar, US tariff shock, global risk aversion, not by India's internal collapse. Does that mean India should be relaxed? No. The 50% US tariff is a real wound on our export sector. FPI outflows at this scale, they are a real pressure. And if crude oil stays above $100 per barrel, the import bill will bite us. But this is not 2013, again I'm saying, not even close. The fragile 5 was a verdict about an economy that had no safety net and no policy credibility, but India today has both safety net and credibility. The rupee is at 95, of course, and it is a stress test. It's not a crisis. The question is whether the government and the RBI are able to pass this test or not. So here is the one line I want you to carry. A currency falling is not the same thing as a country crumbling. The difference lies in the foundation, and India's foundation in 2026 is nothing like it was in 2013. But before I leave you, I want to put one uncomfortable thought in your mind. Everything I just told you about India's improved fundamentals is absolutely true. No minced words over there. The reserves are real, the lower current account deficit is real, the lower inflation is real, and yet the rupee has now crossed 94 per dollar and is approaching 95 per dollar. It has depreciated 12% in the 12 months. Every single month in 2026 so far, foreign investors have been sellers of India, not buyers. And there is a version of the story where India's strong fundamentals absorb the pressure and the rupee stabilizes. The trade deal goes through, FPI sentiment, let's say, reverses, and the currency recovers to mid-80s. That story is possible, but there is another version. A version where US tariff hit proves more damaging than expected. Where crude oil, it stays above $100. Where global risk aversion deepens and FPI outflows continues for another year. Where the rupee slowly drifts towards 100, and where policymakers, having told themselves for too long that the fundamentals are strong, are caught off guard by how fast the sentiments can change. Both the stories are very much possible. Right now, we are somewhere in between. So here is my question to you, and I genuinely want you to think about this and answer this in the comment section. See, India's great strength in 2026 is its domestic consumption. We all know that. Hundreds of millions of Indians buying goods and services within India, relatively insulated from the global shocks. That domestic story is real. But my question to you is it enough? Can a country of India's scale and ambition truly insulate its currency from global forces through domestic strength alone? Or is the rupee's slow drift towards 95, then possibly 100, telling us something about a deeper vulnerability that strong GDP numbers cannot hide? See, the rupee doesn't lie. It just takes time before people start listening. Think about it. Let me know in the comment section. I hope you gain a new perspective from this session. All the very best and have a beautiful day. Thank you.